Hello, everyone. Great to be here. Super excited to be leading the session with Mike. We'll wait just a couple of moments for people to trickle in. Would love to hear where you're tuning in from. Yeah, and then we'll get started in just a few moments. Feel free to use the chat on the right-hand side of your screen. To share your name, where you're tuning in from, and also from the Spring account, we'll be sending any kind of updates, things like what you'll be receiving once this info session is over, which includes the recording and the glossary. And then also throughout the session, I'll just briefly mention if you have any questions, please feel free to use the chat and we'd be more than happy to answer. We'll kind of have a dedicated time at the end of the session to be able to answer your questions. So maybe we'll give it about 30 seconds more and then we can get started. Okay, so I want to be mindful of time because we all have an hour here. So welcome everyone to navigating the investor market, due diligence, term sheets, and negotiations. My name is Ashima, and I am the investment program manager at Spring Activator. I'm also a lawyer, the community manager at Toast, a membership collective for women in tech, and I'm on the board of 2 award-winning organizations. I am super thrilled to be co-facilitating the session with Michael Reid, partner at DLA Piper. Mike works with companies in a wide variety of sectors, including AI, VR, AR, health tech, fintech, life sciences, and at really all stages of the company cycle, from growth to startup to exit. So he advises clients on corporate commercial law matters, including shareholder agreements, company formations, governance considerations, financing matters, whether pre-seed, seed, series raises, private equity, venture capital, and joint ventures. He brings to his legal practice a practical understanding of really what it takes to grow successful business ventures in the modern economic landscape. And particularly on that last point, I think you'll really see that in today's info session. So we are tuning in from the traditional, ancestral, and unceded territories of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat people on all lands, home to many diverse First Nations, Inuit, and Métis people. I also wanted to acknowledge that we have had the privilege of working with partners and supporting entrepreneurs on the unceded lands of the Syilx Okanagan people, and recognize that many Indigenous communities are living on the front lines of the wildfires and depend on forests for food and sustenance. Our thoughts are with all of the families who lost homes, memories, and cherished parts of their lives. So today we're going to be really covering the foundational must-knows of any investor. And before we get into the goals for today, and before I think, all of you have kind of a moment of goal setting and intention setting for yourself as well as to what you want this info session to be for you, I wanted to quickly share that this session is a fantastic primer to the Health Impact Investing Challenge in the fall. So advancement in our healthcare system is critical, especially when we think about an aging population, chronic disease, inequitable access. And through this 8-week Health Impact Investing Challenge, Spring really facilitates a joint cohort of individual investors and top 10 BC-based health impact ventures to navigate all aspects of the investment process. So I'll share more on all of that at the end of the session a little bit later, and I think this would be a great time. I'll pass the mic to Mike to share a screen, yeah, and kind of, get into our goals for today.
Absolutely. Well, thanks, Ashma. I will start talking as I'm trying to share the screen. So bear with me for just a second as this comes through. Are you able to see the proper screens?
Yes.
Perfect. It's come up. Thanks everyone for attending. I see that we still have a few people filtering in, so that's great. As Ashma said, this this next 45 minutes or so really is meant to be a primer on some pretty broad issues around investing. As we say, diligence, term sheets, and negotiations. We're clearly not going to get through everything on an in-depth level. It is a bit of a survey of different issues to start to consider, depending on what your experience is with investing. Some of this may be brand new, some of this may be old hat, but the idea is to try and create this primer so that everyone on the call has a bit of an idea of some of the issues that we'll typically see when going through an investment from the investor side. And this will feed in, quite well to the upcoming health IIC, as Ashma noted, and some of these issues are things that will be dealt with in more depth through that process. So, it's working. There we go. So our goals for today, just again, very high level. We want to make sure that everyone gets a general understanding of the state of the current investor market. Things do shift over time, and particularly the last 2 to 3 years, there have been some significant changes, and other things that haven't changed so much. So we'll be happy to go through that. Talk a little bit about some of the terminology surrounding various deal rounds and things that you'll see come up as you start to get into it. If you don't have a lot of experience as an investor, some of these things may seem a little foreign, so it's nice to have just a little bit of background on it. We're not going to go through an entire glossary, but there will be a glossary circulated later that'll have a lot more minutiae on some of the terms. We'll work through a few aspects of what would typically be in a term sheet that you would expect to see. We'll look a little bit at diligence as well, and how you would look to identify key red flags, particularly important if you're coming in on early stage investments. You're not wanting to spend the whole bank on doing an in-depth audit through your diligence. So how do you issue spots and key items to know what to dig into? We'll talk a little bit about corporate structure and cap tables. Not going to do an entire course on corporate law, but what are the few things that you want to make sure that kind of off the bat, and a few negotiation best practices. One thing I will mention as well, just to follow up on Ashma's note at the beginning, we have set aside some time for questions at the end, but if questions come up throughout, feel free to throw them in the there's chat, and then there might be a Q&A section as well, but put them in wherever you're able to type something. And if something does come up that seems pertinent to address right at the time, then we may do that, and otherwise we'll just call through at the end. Okay, so current market trends. What I would say is that over the last, particularly 2 years, we've seen a lot of movement around the different markets that investments are made through. Inflation and interest rate hikes have been a major driver. These aren't the only thing, but this is one that I want to highlight because it's a question that comes up quite often: is what is this doing to private investment markets? And generally, I would say there's not a direct correlation in every single market, in every vertical, but there's an overall push in the market. Public markets have been overall down, not necessarily in terms of overall value, but in terms of growth rates. There's been a lot of shifting there. As inflation and interest rates have increased, there's been a competition I would say, for kind of medium level growth investments. So where you would have had, previously, certain larger institutional investors looking at making investments for certain yields, they can now get more stable money in different ways because interest rates are much different. So a GIC or other sort of bank level investments are different. So there's a different appeal and a different alchemy that goes into it. As a result of public markets being down, that has a carry on and a knock on effect. Particularly where you're looking at larger VC funds who are dependent on large-scale investors. Those are the people who are considering where to put their money and what their risk profile is, and that's led to a bit of a shrinking and a bit of a holdback in what a lot of those top-end VC dollars are. There's still money out there, but it's moving in different patterns. That's led to a shift, what we've seen, particularly in the Canadian markets, but also in US markets, of a lot, honestly, more deals happening, but smaller. So a lot of smaller bridge rounds happening rather than a company raising 50 million, they've raised 5 million 3 times to bridge themselves. So they've done 3 transactions rather than 1, but they've raised a lot less money as they're doing it. They're still gearing up. There's also been a rise in venture debt. So venture debt, without getting into all the details of it, is somewhere in between kind of traditional bank debt and a convertible debt, which is really meant to happen at a later stage. It tends to be shorter term, higher yield, and have some other facets to it that do tie it into more of a venture direction. And this is something that if you're involved in the IIC, I'm sure Nimbus would be happy to speak more specifically on venture debt. But there's that has come into vogue a lot more, and a lot more investor protections are in place now. So as an investor cohort, that's something that you can, it's a positive that you can look towards. There's a lot more risk mitigation, and a lot of companies are more willing to consider that mitigation at earlier stages. Definitely want to make the point, though, that deals are still getting done. There's an increased interest in angel funding, increased interest in those, like I say, those smaller bridge rounds. Family offices, which tend to be essentially operate like funds, but they're pooled from a much smaller. They're not kind of publicly open to an entire cohort. They're usually 1, 2, 3 individuals or families that come together and pool funds. There's been a real growth in that area, and other non-venture capital states of funds. There's also growing interest, and this is, I think, unrelated to the inflation and interest issues, but just in terms of generally in the market, there is a growing interest and desire by a lot of investors to put money into areas of impact, which is obviously very broad and something that the IIC gets into quite a bit, discussing what impact really means. ESG is obviously a big issue, top of mind to everyone. We were talking just before the session started here about how we're happy that the smoke has been clearing out of our skies, and that's something that there's a lot of things that a lot of us see daily that are prevalent, and that's really driving kind of the ethos of a lot of this kind of current investment as well. Specifically in terms of health tech and recent market trends, these are not, this isn't an exclusive list. There are other areas as well, but some of the key areas that we're seeing in terms of real growth in investment in health tech and growth in health tech startups is telemedicine, so distance, serving patients from a distance, personalized medicine, so that real customization aspect, femtech, genomics, wearables, and Internet of Things has grown. Again, there was a bit of a growth period a number of years ago, and it leveled off, and it seems to be increasing again. Digital health, AI diagnostics is seeing a lot of growth, obviously spurred on by growth of the different language models and ChatGPT, and it's captured the public imagination. So there's a lot of growth there in actual application. And then extended reality. So various forms of augmented reality, mixed reality, virtual reality within the healthcare sphere. So these are I guess, 8 that we would highlight, but there's dozens of other areas and niches that you can get into. And then I think Ashma had a few things to say about 4 of those specific areas.
Yeah, I think, I think it's great that, Mike highlighted certain sectors, certain areas that we're seeing particular trends or growth within. And I sort of wanted to talk about these 4 a little bit more in detail and really hone in on the use cases investors should generally be aware of, and really what problems and needs consumers, patients, doctors, hospitals are identifying across specific health sectors. And I'll also just say that, these are also many of the verticals that our top founders selected for the Health Impacting Investing Challenge are actually building within and creating within. So speaking of AI, generative AI, Melissa Barotorli, who is the health investor at Polaris VC, she actually recently released a study where she spoke with a number of physicians about what are some of the use cases at the intersection between clinicians and what they need and generative AI. And so some of the things that they had highlighted was relieving their administrative burden. The second was documentation, both on the side of patient-centric documentation to explain certain terms, to explain, let's say, discharge information, and then also on the clinician side of things, whereby generative AI would be used to record sessions or craft notes for the physician. Diagnostics, clinical decision-making was discussed, and also in the realm of mental health care screening tools to provide better access to mental health care, whereby between sessions, AI would actually deliver some of the touch points. One of the final things that was mentioned was asynchronous learning tools through video lessons, interactive content, and really considering the needs of the physician when it comes to how to utilize their time and what would be best served when it comes to the best way to utilize their time. So in transitioning to femtech, and it was interesting when I was even doing my research about what are some of the trends in femtech, because one of the big things that was highlighted across all sectors was that when we're creating these platforms, intuitively designed platforms, it's important that when we talk about the data sets that are being used, that these are unbiased, high quality data sets, and they're building culturally competent models. So how does this connect to femtech? When we think about really modern medicine, for years, women have been underrepresented in medical trials, and women have really experienced differences when it comes to delivery, when it comes to their healthcare delivery. So this gap has highlighted that there are really remarkable opportunities for improving women's health. When we look at some stats that I wanted to provide you, Q3 of 2022, the femtech investment reached $16 billion. And it's actually projected that it will be nearly $1.2 trillion of an industry by 2027. So when we think about looking forward and what are some of the opportunities in these spaces, it includes leveraging technology to address women's health issues that really go beyond reproduction, and includes even actually significant partnership opportunities between legacy players. So for example, L'Oreal, one of the leaders in cosmetics, they recently unveiled a partnership with a period tracking app called Clue to deepen the knowledge between the relationship of skin health and our menstrual cycles. So merely kind of gendering products has been really missing the point. It's about understanding women's genuine needs. And 2 quick shout outs for anyone who is interested in this area or wants to do more research. that are Canadian-based are Eli Health, co-founded by Marina Rivas, raising 3.6 million, and Fem Therapeutics, co-founded by Inara Lalani and Nagin Ashuri. Both of these are Montreal-based, and I think are huge highlights of what the Canadian landscape can look like when we think about femtech. Moving on to wearable tech. So, like putting this very briefly and concisely, it's really that some technologies maybe can facilitate health promotion, disease prevention if used by people, let's say autonomously. Maybe that's like weight management, physical activity monitoring. And also, there are ways to use wearable tech in collaboration with healthcare providers to, let's say, oversee and monitor patient outcomes. And then the final thing that I would briefly touch upon is digital health. The government has kind of released a lot of information, probably also due to the pandemic. And there was a survey that was recently published by the Canadian Health Infoway in August of 2021 that found that 94% of physicians were currently using some form of virtual care. And though, yes, we saw a huge transition when it came to the pandemic, we're seeing even post-pandemic, what are some of the use cases when it comes to digital health? And one of the ones that I would mention again is mental health care. So in addition to telehealth visits with providers, mental health apps, and online group therapy, we're seeing this kind of positive difference that is being made in patient lives, whereby when it comes to tracking patients, when it comes to kind of those touch points in between sessions, there's a way for digital health and virtual care to almost lend a supportive helping hand and really make positive benefits for both patient and healthcare provider outcomes. So I'll leave it at that. And I'll just say, more than happy to, I'm sure both Mike and I are more than happy to chat about this after. I'll be providing some resources when it comes to kind of some of the research that I've done. But yeah, I think I'll leave it there and I'll pass it back to Mike.
Great, thanks. So, moving on to the next section, we're going to run through just some key terminology that's helpful to think about as you're entering into an investment pool. So one of the interesting things about investment is understanding what a lot of these different investment rounds even mean. So everything you see listed here: bootstrapping, friends and family, pre-seed, angel, seed, seed plus, Series A, bridge, Series B, venture debt. This is structured here as if it's a continuum, or as if it's a list, but really it's a continuum. And these are words that you'll hear come about quite often when you're starting to deal with particularly early stage founders. You'll hear a lot of these. So, bootstrapping is reference essentially to a company that is not taking outside funding. So this is something where founders are either putting in their own money or just their own time, or if they're the type of company that can hit an early revenue stage through using those revenues for growth as opposed to taking in a lot of outside money. Bootstrapping isn't just the first thing that you do. It's often the first thing, but it's something that can continue on quite a ways for certain companies. Friends and family is exactly like it sounds. It's taking in money from people who you're close to, business associates, people that you know personally. Family tends to not have a lot of heavily negotiated terms. You usually don't want to leverage your uncle too much when you're raising money, so it can lead to some interesting results. The next series of pre-seed, angel, seed, seed plus, I'm gonna say are meaningless. They do carry some meaning to some, but really the distinctions between them are not all that important. It's, I'd say 5 years ago, you would talk about a seed round and that was about it. As time has moved on, sizes of rounds have really grown and there's been a kind of stratification. And so there's been a need to kind of come up with different terms to designate, what this particular round actually is. And you'll see many different companies going through multiple rounds where they're still early stage, so they probably don't have much in the way of product yet. But rather than doing a single round where they then have enough money to get them through the next 18 months of product development, getting an MVP, getting on the market, having revenues come in, there's often multiple inflection points. And so you see kind of a stratification there. Different groups will kind of point to different thresholds at which this is you're going to distinguish a pre-seed from a seed, or a seed from a seed plus. I personally don't find that I don't put a lot of value in that. I think it's helpful to speak the same language as the group that you're talking to. So if you're talking to a particular angel collective and they want to call it a seed, you call it a seed. But beyond that, it's fairly open. The Series A is the really big inflection point. So Series A is typically where you're going to see a larger institutional or VC firm come in, really put the boots to the company, quite honestly, in terms of the negotiation. Really get a lot of structure in place that may not have been there before, get a lot of specific rights put in there, get some preference in their shares, a whole bunch of different things that sometimes will have already started to come about in the seed, sometimes won't. But that's a real tipping point. Series B, Series C, Series D. Some companies will go up to Series M. These are progressively larger rounds with sometimes some of the same and sometimes larger investors coming in. A bridge round is usually something that we'll refer to as any sort of round that goes in between two others. So you're bridging yourself from here to there. It tends to be shorter term. So as I was saying, as the markets have shifted over the last 2 years, there's a lot more bridge rounds. What's been happening is, a company that was, looking to raise $10 million a year from now needs a bit of money to get there. They need $500,000 or $1 million to get into that, kind of take them through that year. So they raise on bridge financing, which might be on a convertible note or a SAFE or something that's a little bit up in the air. And what's happened is we've ended up, because markets have shifted, that $10 million raise gets pushed out further than they had planned. They need another bridge. So it's really a bridge to a bridge to a bridge, which I've started to call island hopping, because they're still waiting to get to the mainland of that larger financing. And then again, venture debt, which I'd mentioned off the top, is also something that's out there that's a little bit different. It's not. It does have some equity backing to it, but it's not. Its goal isn't equity. Its goal is debt. But it is becoming more common as being an actual round of investment with multiple investors coming in that as lenders, as opposed to coming in as investors. And it's important to understand the distinction between being an investor and being a lender. Being a lender means that you have a specific shot clock going on when your money is supposed to come back. Being an investor, you may have goals, but you're in it for a longer haul, particularly when you're coming in at an early stage. Other terminology that will come up, particularly when we're talking about equity investments, is what you're actually buying. So you're investing in a company, but what does that mean? There are multiple ways of carving this up, but the four kind of key categories to think about when you're investing would be common shares, which are the kind of foundational building block of ownership of the company. A SAFE, or a convertible debt, convertible note. These are convertible instruments where you're putting money in now. There's conditions around it, but it will become shares at a later date usually when there's a larger fundraising, when someone sets an actual valuation of the company. And then preferred shares, which can come in at a seed or a series level. And these are built on top of common shares. They have the same kind of equity ownership of the company, but they also have additional rights, approval rights, and participation rights on an exit, and a variety of things. What's really key to understand about this is that these are all pieces that we would usually look at as being part of an equity investment, but only two of them are actually equity. Right? Only common shares and preferred shares are equity ownership of the company. The SAFE and the convertible note are contracts which if all goes well and according to plan, have a conversion point in the future in which they become equity, but they're not at that point. So they don't carry any inherent rights to them other than what you put in the contract, which is a key to understand, particularly if assessing risk and understanding what happens on the back end. So just to break down a little bit of the difference between them, I've already gone through a little bit of this, but so common shares. So we've structured this as the types of agreements, but they all map very closely to what the actual underlying security is that you're buying. So the common shares are something that you simply buy, you pay cash. There's a cash value on the common share. It's $1 per share or $2 per share or 7 cents per share, whatever it is you're subscribing. The company is they're creating new shares and issuing them to you. Typically, as an investor, you would only really expect to be buying common shares at a very early stage of a company, potentially. That will often happen in maybe a friends and family round, or sometimes an angel round where you're coming on almost like you're a founder yourself. And really the biggest thing that you're negotiating there is the share price. The SAFE, this is again something that converts in the future upon the next time money is raised. That's very common to use in a bridge round. So like I say, that short-term kick. It's also become more common to use as the actual, it started out just as a bridge instrument. It's now become far more common to use as a round instrument itself. So in a pre-seed or a seed round, anything that's called seed, you might see that, you might see multiple. So you might see 2 or 3 or 4 different rounds that have safes in them that have some slightly different terms, but those build towards a real series round, a real heavy priced round. Within a safe, you're negotiating things like a valuation or a valuation cap, rather. You're negotiating potentially a discount, and a bit around the mechanism for conversion. Or for non-conversion, rather. So what happens if nothing ever triggers the conversion? The default is nothing happens, and it will sit there forever. So it's a bit riskier for investors. Convertible loan is a little bit different. It's essentially the same use case and same types of things negotiated as the safe, but adds on protections of debt. So you may have interest accruing. So the longer your convertible note sits there, the more it grows in value. You may seek security on it. So have a secured convertible loan, have collateral guarantees, things like that. So these are all, what happens if the company goes out of business? Well, now you're a lender. You're actually ahead of equity, as opposed to what happens in some of the others. And then finally, the preferred equity is similar to the common shares. You're subscribing for newly created shares. This is going to be in your Series A, Series B. Sometimes you'll see that in a seed. There will be some very simple preferred shares, but these will all have special rights that will go along with them. So you have ownership of the company, but you'll want special approval rights over the company taking certain actions. You may have. It used to be more common to negotiate accruing dividends. That's less common these days. Oftentimes, if I see dividends negotiated in a Series A, they're removed in a Series B. So it's something that you'd want to think about. And the big one is usually the exit bonus. So what's your preferred rights on an exit? That is usually stated in a manner that would say that the preferred shareholders receive basically first dibs on the funds on an exit. And what that means is that if the company were to sell for less than the value that the preferred shareholders were investing as if the company was worth at a lower valuation, that the preferred shareholders still get paid out in full, and then common shareholders take a smaller part of the pie. Other times it can be stated in a multiple. So you get 1.5 times your initial investment guaranteed before everyone shares equally. So there's various different pieces that go along with that as the investments continue on. I won't focus too much on the next couple slides. We had some kind of random terminology to throw in here, but we are circulating everything in a glossary as well. So just as a really quick run through it, you might hear about MFN clauses. That just means most favored nation. Most favored nation means it's terminology that comes out of treaties, but we use it in finance for some strange reason. We didn't come up with a different term, but it essentially means that if you're negotiating terms now and someone else later gets better terms, you get to carry on with those terms. A preemptive right means that you have an ability, typically it means that you have an ability to participate in future rounds to maintain your same level. So it's an anti-dilutive right, but you have to pay to play. So the idea that if you own 3% of a company and then they go out to sell more shares and that's going to dilute everyone down, you have a right to buy 3% of that new financing so that you can maintain your position. Qualified financing, you hear a lot. It doesn't mean anything in and of itself. It's something that gets defined within a document. So if you have one of these convertible instruments, like a SAFE or a convertible note, the qualified financing is going to be what triggers that conversion. So what qualifies a financing? It's usually has to be more than just someone putting in another $100. There's going to be some sort of threshold that they have to hit. As I'd mentioned before, the 1x, 2x, 3x, these returns, when you hear that, and that's how people will refer to it, like, oh, a 2x, that's just a reference to the rate of return that they received on their investment. So if there's a guaranteed participation that's 2x, that means they're guaranteed to receive twice as much back as they put in. Valuations. So when we talk about valuation or valuation cap, it's really important to understand the difference between pre-money valuation, which is the value of the company before the investment was made, versus post-money valuation, which is the value after. Pretty easy conceptually to think about why there's differences there. If it's a $10 million company and I'm putting $2 million in, it's worth $12 million after, because it now has its original value plus my $2 million. The reason that this can be important to understand the difference of is when you're doing calculations, it's important to understand where that $2 million that you're talking about actually comes in. And if I say it's a $10 million valuation, I don't know if my 2 million is inside of that or outside of that. That can lead to a very different calculation of what I receive in the company. Okay, working through a term sheet. So term sheets are generally the first thing that you're going to see. So as an investor coming into a potential investment with a company, the first thing that you want to do is make sure that the high-level terms of that transaction are understood. It's really key to understand kind of what that is before you start spending the time and money in conducting your diligence, in reviewing and preparing actual investment documents, and getting your lawyers involved to do all of that. This is important from both the company side and the investor side. This is let's agree to key terms so we don't waste each other's time. Understanding what those key terms are, though, is important. One thing you don't want to do is go off and negotiate a term sheet and then take it to your advisors and say, hey, we're set on all the terms, and the advisors to look at it and say, well, this doesn't tell me of what I need to know. We still need to negotiate a lot of key things. Having said that, term sheets don't include everything, but they really are like, here's the deal breakers. You need to know what the deal is, and if there's anything that you absolutely require, make sure that is in there. The little list here, obviously, of the kind of typical details that are going to be in there. You want to know what it is that you're actually buying. So what is the security? You want to know what the size of the offering is. Are they raising $100,000 or are they raising $10 million? What's the overall? What does that look like? How is the pricing being determined? Is it just set out straight in the document already? Is it going to be based on a valuation? Conducted at what time? Is that a pre-money or a post-money valuation? Is it going to be a calculation around some sort of accounting issue like EBITDA or net revenues or something else? And when do they expect to close? Again, lots of other terms that can come in here, but those are kind of typical initial details. In a bit more granularity, a term sheet will often be broken down into non-binding terms, which are all the actual deal terms, and then binding terms, which are about what your relationship is while you're negotiating. So the non-binding terms that you're going to want to see are going to vary depending on what it is that you're buying. So if you're buying shares of some sort, you're certainly going to want to see what the price per share is, or how that will be calculated, sometimes on a valuation basis. You're going to want to know what the share rights are. Are these common shares? Are these preferred shares? What does that mean? On a SAFE, it's really just the conversion mechanics. So valuation cap, discount, threshold for conversion. Convertible note will have all of those as well, plus your interest, maturity. And then what else, right? Are you going to have information rights? So what information will the company have to provide you on an ongoing basis? Do you have pro rata rights? These are those preemptive rights I was talking about before. Do you have a right to participate in future financings? What are the closing conditions? What else needs to be done in order for you to close this, other than just you signing a paper and handing over the money? Is the company going to require anything else? A shareholders agreement, a voting trust agreement, anything like that? You want to make sure that that's clear from the outset, so that everyone's on the same page. As an investor, you might also be very concerned and want to make sure it's clear what the use of proceeds is. So are the funds being used to grow in a certain way that you understand and approve of? Essentially, it's your money going into the company. So how are they going to use it? What kind of controls might you have over that? Again, early stage small investment, you're going to have much less control than later stage large investment. And then binding terms are fairly simplistic. It's confidentiality of information, how fees and expenses are handled. As an investor, are you able to essentially charge the company for the fees that you're going to incur or not? Again, depends what position you're taking as an investor. And the governing law, just making sure that we all know if there's ever a problem, what law do we look to? Not too big of an issue when you're all in the same place, but when you start looking at interprovincial or international, it is actually becomes quite handy to understand. Do we have to, if there's a problem, do we have to go figure out how to do this under New York law or London law or what? So once you've gone through your term sheet and you've got your key terms determined, you're ready to move ahead and make some decisions. Sometimes the term sheet comes after diligence, I will say. Sometimes it comes before. Really depends on how kind of organized the company is and how structured things are. But due diligence is something that's a real key as an investor to run. Due diligence is a big, broad term that just means everything that you might want or need to ask, so that you can understand the company, the investment, the market, the competitors, the governance of the entity that you're looking to invest in, the founders, the product, everything. So key areas of diligence that you're going to want to consider and decide how deep you want to dig into any of these things, depending on what your investment is and what your role is within that investment. If you're $10,000 of $1 million investment round, you're probably not the one digging in deep on diligence. If you're leading the round and you're putting in $200,000 of $250,000, you're probably going to want to be a lot more diligent about what you're digging on, because you can't rely on assumptions that anyone else has looked at it. These sorts of red flags can vary greatly depending on the age and stage of the company. So really understanding, a very early stage company coming for their first seed round is going to be messy, always. Never seen one that's clean. Doesn't matter how diligent they've tried to be. If it's their first time doing it, there's going to be little loose ends, and that can be fine. But understanding what they are and knowing whether something is a big deal or not is something that you kind of try and tease out as you go. So some of the red flags that I've noted down here are general lack of organization or expertise. So you definitely want to ask yourself, what is it that these founders know how to do, and what is it that they're actually doing? Every founder starts by wearing many, many different hats. So again, that's fine. But where are they at this stage? Are they still doing things that they shouldn't be doing? Have they hired the right people who are experts to fill in the gaps of the things that fantastic founder doesn't know how to do? And are they organized about it? Are they approaching things and trying to mitigate risk by bringing in kind of, whether that's outside experts or internally hiring? That's part of a team building. It's part of a governance question. Does lead to corporate governance. So, and this is obviously, as a corporate lawyer, this is something that's near and dear to me, and I end up focusing on a lot more than a lot of my clients oftentimes. But are the corporate books in order? Have they actually kept track of things properly? If it's not clear, if the corporate books aren't in order and you don't know who actually holds what in the company, who owns what shares, we've gone into diligence on companies before, and we look through their record books and none of it lines up. Their cap table doesn't match, their share register doesn't match their resolutions. So we don't know who owns the company. We know it's a bunch of this group of people, but we don't know if this founder owns 40% or 30% or 32%, because nothing's documented well. And that becomes really problematic, because if you're investing, you want to know what you're buying, but you also want to make sure that the next time that there's investors coming in, they're not going to have these same questions. So part of what you're doing every time you invest is think, I eventually want someone to buy these shares from me for a lot more than I paid for them. Are there roadblocks now that we can see? Those may not be things that block you from making that investment, but they may be things that you then want to condition the company to make sure that they clean up. Intellectual property is another big one. Making sure that the company has the documentation it actually needs to ensure it owns its IP. So if they've been using contractors, if they've been using employees to create things, third parties, do they have IP assignments? Do they have documentation that actually shows a good chain of title? And this isn't just about registering IP. This isn't just about patents or trademarks. This is about kind of more generally, copyright covers every bit of, if they create software, if they're preparing other, documents to use for things, do they actually own it? Can they walk away with it? And the last one that I'll put on this piece is clarity of terms. So when you're negotiating terms with an investor, do they understand? Do they understand what they're selling to you? This is a really nuanced and critical piece that we've dealt with many, many times, where you may have you can have a founder, you can have a CEO who really does their area really, really well, but they don't necessarily know how to run a company. That's not the end of the world, but you need to make sure that you understand where their strengths lie. Not every good engineer makes a good CEO, is the way that I put it. And I can put all sorts of different things in there instead of engineer. Not every doctor makes a good CEO, right? We're talking about health. Some of them do, but some of them need more help. So really understanding, making sure that when you're negotiating for terms on different rights that you have, that the company understands what those rights are. So you don't necessarily want to set up a situation where you've got good rights on paper, but in practice, no one's ever going to, you're supposed to approve of a whole list of things, but the company never pays attention and doesn't understand what they're supposed to do. You're not just setting up for a fight later. You really want to make sure that everyone is clear on how this works. I know we're coming in 10 to the hour now, so I will try and go through the corporate structure piece a little quickly. So questions that you're going to ask around corporate structure are here. It's really just understanding what the company is, where it exists, what are the share classes, who owns it, are there governing agreements like shareholders agreements. Really just understand what it is that you're buying into. There's a whole nest of things there to really ask. And so it's helpful to understand what that is. In terms of cap tables, which I'll focus a little bit more time on, cap tables are important because they give you a good calculation and visualization of who owns the company. They tell you how it exists now. They tell you certain things that can happen in the future. They can give you a little bit of an idea of the history of the company as different rounds of financing potentially have been done, how they've been conducted, who's bought what, who's taken control in certain areas, and they can help you model out what future rounds look like. They can also tell you who has the right to make certain decisions. They're a useful tool for a company to have, but for an investor, they're also very important to just really look at, and from a red flag level, just make sure that the company understands it again, right? Make sure that they actually have some organization in place. So quick just sample of a cap table here. This would be a very, very simple cap table. This is just something that was modeled out in Excel, which is very typical. There's lots of higher end software, SaaS products where you can do cap table management. Generally, a small, like early stage company isn't going to be, doing a $5,000 a month subscription to Carta. So they might use something like this. So, what does this cap table do? It shows us who the actual owners are. So here are all the people who have something. They have some sort of shares or convertible rights into the company. In this one, we have, this isn't always the case, but we've categorized them, right? So you can see who are the founders, who are the investors, who've put cash in, who are advisors that are probably receiving their equity in exchange for services, who are employees who are receiving something either in exchange for services or incentives. So again, you can see this helps you figure out a breakdown of not just who individually owns the company, but what type of people own the company. What are the categories of them? You're going to see all the different types of securities. So here we've modeled it out with voting shares and non-voting shares and options. You can also have cap tables that will build in different calculations for convertible notes or safes. You'll have different seed rounds. There might be 10 different columns here. But they'll all break down and show you who owns what, right? It's typical grid. Now we see, so with this, we've got a couple different columns here that show totals. So there's one that's not highlighted, that's the total shares issued. So that tells you kind of what's issued versus what's convertible into or options for. The full dilution, this is kind of what we're looking at as if everything was exercised, if everything was converted, if everything that could be a share was a share, what would the numbers look like? And then from that, we calculate the net equity ownership. So this looks like if there was a sale today, what would the breakdown be? And this is assuming, we've got an option pool here that's unissued. So this would be assuming that we're actually going to issue all those options. But this is the percentage. When people really want to look at how much of the company do I own, this is what they end up looking at. Because this will tell them, as of today, if everything were to be exercised, converted, anything like that, and the company sold for $10 million, I have 1.44%, so I'm going to get 1.44%. Would be the case. Okay, really quick, because we said we'd go through negotiation best practices. Best practices, as I said, start with a term sheet, get your fundamentals in first. Don't get dragged into negotiating terms you don't understand. If you're not sure of it, get advice on it, or just don't do it. Definitely don't just agree to something and sign off on something that doesn't make sense to you. It may not be. There's sometimes, and I've dealt with this with a few clients as investors who, everyone's got a bit of imposter syndrome to them, and sometimes you think that it doesn't make sense because you just don't understand it, and sometimes it doesn't make sense because they don't understand it, and they're telling you something wrong. So definitely there. Be realistic about your timelines. These things do take time. Sometimes things can go quickly, but it's generally not in your interest to go too quickly if the terms aren't right. Don't over negotiate. I mean, this is very much an advice to investors to not hamstring your companies. Try and be reasonable. Make sure that, yes, you need to protect yourself, but if you protect yourself too much and prevent the company from actually using the money in the way that they need to, that can be a problem. Get approval rights for things, but if you're going to get approval rights for things, make sure that you're Johnny on the spot about responding. Don't don't ignore, the request for a week or 2 weeks because the company needs to move faster than that. And then valuations, these vary, but again, make sure that if you're talking valuation, you actually understand what you mean. This is kind of a pre-money, post-money. This is all sorts of factors in that. I don't think we need to go through this too much, but there's a number of different things that as the company progresses and the size of the raise, the financing increases, there's a number of negotiation points that are a spectrum. So you will move from being more company friendly to being more investor friendly. Early stage, you can expect founders to be providing you with terms. The further along you get in stages, you can expect the investors to be dictating terms. If it's very early stage, don't plan on having a lot of specific rights for investors. As you grow in the investment size, you will get more. Same with things like board seats or observer seats, and the entire process. So again, a $250,000 entire financing, you're not going to be doing a lot of due diligence. There's probably not going to be a lot to actually review. The company won't have done a lot. There's still a few questions to ask. You're doing a $30 million raise, ask a lot of questions, dig into everything, review every agreement. Right? Those are the types of things. And then rolling close or fixed close, these are just terms that essentially a rolling close is where they close each investor as they come in. A fixed close is one where they have to hit a threshold, so they can't close anyone until they hit kind of a minimum amount, which can be important. And then I just got a quick slide on timelines. These aren't set in any particular way, but just to think about, when you're, a Series A taking 5.5 months is not abnormal. A seed taking anywhere from 1 to 3 months is not abnormal. It's everyone wants to be able to turn things around quickly, and these aren't average times. Like, these are kind of max times on the pre-seed. I've never done a pre-seed that's actually taken 3.5 months, but it's just as a visualization, you do want to think about the fact that that everything does take time. The more organized the company is, the quicker due diligence will go. The earlier stage they are, the less likely they are to be organized. So sometimes, even though the terms are simpler, it's first-time fundraisers don't necessarily know everything that they need to do right off the bat. They need to be walked through it by their own counsel. They need to be walked through it by you, the investor. So just make sure that you try and give the time that is needed to make sure that the company can do what it needs to do, and that you get the information that you need. And that is the last slide. So now we can get to, if there are questions, I
was going to say that's actually a really great segue, because Mari actually has a question on timelines related to if you can speak to some exit examples as of late and what you're seeing in terms of the length of return in the market these days.
Yeah, I mean, length of return, long time. It's definitely not a short. I mean, so it's hard to say right now, because I would say that everything has a lot. Well, not everything, but a lot of kind of timelines for most things to do with finance have extended. Mm. So, financing timelines are taking longer. Due diligence is taking longer. Everything is kind of stretching out, and I don't know that that's had a direct impact on exit timelines just yet. But I mean, typically, if you're coming in at an early stage, a lot of this really depends on stage as well. So if we're thinking about, very early stage, kind of pre-seed and seed level, I mean, you gotta think that for most of these companies, they've got at least 5-6 years before there's really a possibility for most of them of some sort of acquisition, if they are being acquired by a company who, a strategic acquisition by a competitor that's looking to accelerate themselves,
Mm.
by adding a component. If you're thinking about an exit, kind of more of a full scale exit of this is a massively valuable company itself that's going to be bought out to be run, kind of in its own right, or by a much larger conglomerate, that you're probably 8 to 10 years is going to be more common. It's definitely like these are definitely not things that you would think of as short term. Like these sorts of investments or venture style investments, venture growth style investments are not short term turnaround. They do run for a while. Having said that, I'm also seeing more early stage acquisitions than there were a number of years ago, on that acceleration basis. So I haven't seen a recent study that's looked at kind of the kind of mean and median and mode of exits, and I would be curious to see if that's shifted as well, because I'm seeing both longer and shorter. So the average might actually still be about the same, but I think there's a lot more variability, in those exit points for sure.
Okay. One question that I did have, and I know that we're on the hour, and before I get to kind of Mari's second question, more related to the health IIC, I think one question that I did have, would just be to understand that, do you think the pandemic has really affected whether, let's say someone is doing a raise on a safe or convertible note? Do you think the pandemic has had a big impact on that? Or have you just seen any kind of general trend from pre-pandemic to now in terms of the way that entrepreneurs or founders are looking to raise capital, the types of, deal terms that they're negotiating with investors?
The pandemic itself, no.
Okay.
No, I didn't really see much of an impact in terms of what kind of how people were conducting investment. I think what I saw and kind of ties into the what we're talking about here for this particular kind of focus is, it was more of a sector variability. So I think there was a huge growth in, kind of the health tech companies out there raising money, and the money that people were seeking to put into health tech. I think it was just the focus, overall. Like there were certain verticals within health tech, like, telemedicine, that clearly had a direct, like there's a direct one-to-one relationship there. But I think there are a lot of other, kind of related fields and related verticals that also just started to get more attention, because there was such a focus on health. I don't think that the, kind of how they were raising, what they were raising, changed how much they were raising. Definitely it increased, because there was more, availability of capital. I think that's the part now that we're seeing with kind of more economic shifts is just being held off a little bit. It's still there, but it's definitely, just taking a few more hoops to jump through to get it.
Yeah, definitely. I think, I think my final question, would be that, like, in terms of, one of the things that when I speak to investors, they often bring up that, there's a lot of, when it comes to health tech specifically, there's a lot of regulatory or legal policies, compliance that I need to consider. So how do I balance that in tandem with, let's say, product market fit, or seeing that this founder has created a real solution to a need? So in regards to that, the type of regulatory and legal compliance, is there any sort of, like tip or, practical consideration that you would kind of give to an investor who's thinking about that?
That's a great question, and I think it's a great question for investors to be having of themselves. I think that the my advice to investors in that situation would be, again, it kind of ties back to the expertise point, right?
Mm,
Understanding who the founders are, what their background and experience is, what their knowledge base is, and this applies to any, I would say, really to any regulated industry, and particularly in health, is, who are they creating a solution for, and do they have the requisite knowledge to do that? So if you are, if you're creating a solution, to if you're creating a patient care solution, let's say, and your focus is on from the patient side, and you don't have a background on the medical side, or someone on your team to have that background to understand kind of why it's run this way, then that's a red flag for me, right?
mm,
So, it's the wouldn't it be great as a consumer if I could just get X that I want, without understanding that there's a reason why I can't do that, right? Um, that there's some law in place or something. So it's creating a solution for a problem that, without understanding the framework of why that structurally exists, I think that can be a real challenge. So when you do see, I love when I see health tech founders who come from a background where they were using this, and this is something that
mm.
I was a GP, and this was always a problem. This was always, an issue that I wish that I had this, and I'm creating a solution for other GPs. And here's how it will service all the other stakeholders. But I'm coming at it from a very specific point of view of understanding what the pain points are, and why those pain points are there in the first place. That to me is, it's a compelling story, but it also provides a lot more confidence in, anytime you're talking about product market fit, anytime you're talking about regulatory hurdles, you have someone who actually understands that background. Um, I think that's fantastically important. I'd be scared of an AI diagnostics tool from someone who has only built websites, and wishes
Mhm.
he was better at doing, something, and doesn't have, medical experts as part of their team.
Mhm.
Doesn't mean that the founder has to be, the end all be all for all of those questions, but what does the team look like? What does that process look like for them?
Yeah, no, I think that's a really, really great point that you mentioned. And I think that a lot of investors should keep in mind, like you said, who is actually part of the team, who actually culminates part of the team, what is their expertise in the solution that they're selling, and what is that kind of correlation between, again, the solution, whether it's the product they're offering, their service, and the team itself. So I want to be mindful of time. I'm going to quickly answer Mari's question, and then I see another question as well. So very briefly, just kind of mentioning, some of Spring's experience and history of running these programs. We've been doing impact investing challenges in general for about 5 years. And funnily enough, I feel like Mike can probably speak to that a lot more than I can. But when it comes to our health impacting investing challenge, I think some of the founders that I would really highlight, one being Voxel Bio Innovation. So their valuation has grown about 1.3 times. They're at a 7.5 post money valuation as of May of this year. They were also selected as one of the top 15 ventures in Canadian Venture Magazine. There's UVX. Their valuation has grown 1.5 times. They won the grand prize in the startup category of the 2023 National Impact Challenge by AgeWell. And then lastly, but not least, is Heal Mary. So from 2020 to even 2021, they 3x their revenue growth, and they're also one of the winners of the Arthritis Ideator Awards. More than happy, for anyone in this call or anyone watching the replay to be able to provide really more examples on how the founders that we've had in our past impacting investing challenges are doing. Because, Mike mentioned it, I'll mention it again, that angel investing in a very direct, blunt way is risky. And so it is important for you in this call to know, when we're talking about kind of these impacting investing challenges, what does the history show as to the way that we lead these challenges and who the winning companies are then, and then also where they are today and now. And then the final question, I have to clearly give a shout out to my dad, is once an investment is made, then what support is provided to investors on an ongoing basis? So I think I would talk about this in almost two ways, and I think the second way I'll ask Mike about. So when it comes to once an investment is made, what kind of support is provided? I would say that specific to the health impacting investing challenge, you as an investor then become an alumni investor. So what you actually receive is a membership to our Spring Investing Collective, which is really our network of angel investors that receive access to deal flow. So in terms of support, if you're looking to build a network, if you're looking to continue to expand on your knowledge, not only in relation to navigating the investor market and what we've talked about today, but also in relation to, let's say you want to continue to diversify your portfolio. Let's say you want to learn more about health innovation, but another sector that you're interested in is climate tech. Being a part of the Spring Investing Collective is a great way to be able to do that. And then the second thing that I would say is, and maybe I think this would be a great opportunity for Mike, for you to jump in, is for investors, like even in the health impacting investing challenge cohort that I'm currently building, all of the investors have mentioned some type of role around wanting to continue to mentor founders, wanting to continue to be consultants with founders or to founders. So in terms of that relationship post-investment between the founder and the investor itself, the angel investor itself specifically, are there some, dynamics that you could kind of very briefly go into that you've seen or that you've noticed that kind of the founder and the investor have post the investment?
Yeah, I think it's fairly common once you're an investor, particularly at an early stage angel level, however we want to refer to it. Once you're an investor in the company, whether you're holding shares or something convertible into shares, you're aligned, right? You want to see the company do well, and I think to the extent that an investor has something to offer, has expertise in the area, whether that's specific to the marketplace that they're in, or whether that's expertise within a certain field of something that the company might need. I think having that ongoing relationship and dialogue is important, and a lot of that is just about how relationships develop, and what that offer is. I would generally advise most angel investors not to impose themselves too much into the company. You don't want to, and there's always a line to walk there. You don't want, to have, 40 angel investors individually demanding information on a daily basis of what's happening with this, what's happening with that. A well-organized company will have something in place to send out, monthly or quarterly updates, to keep everyone engaged. But where there's an opportunity to offer on an advisory basis, and this is usually something that will happen on kind of an ad hoc way. It's not always formalized, but I've seen over the years all sorts of different relationships grow from that, where it's an angel investor who becomes a more key advisor to the company because they have 30 years of experience in this in farming, and it's a farm tech company, and there's something there. Or opening up your own network, being able to pass along interesting opportunities to other people, not just necessarily being a brand ambassador, but actually offering those sorts of connection. I've also seen investors where there's just interesting offshoots. So someone who had a background in insurance, and there were certain issues coming up, and they let the company know, hey, there's these things that I'm hearing about, and ended up being an insurance advisor for them, and not in a business development sort of way, but just in that kind of company advisory way. So there's always opportunity, I think, to reach out, and yeah, it happens. I think it's frequent, and I think a lot of companies, that's what they're looking for at an early stage is,
Right.
how do we get someone to pay us and then also give us freedom? I mean, that's a pretty good deal for a company. So
Yeah, definitely. Okay, this has been great. Lots of information. Everyone will receive the recording. And Mike mentioned at the start a glossary that kind of will contains a lot of must-know terms of any investor. And then if anyone has any questions about the Health Impacting Investing Challenge, please feel free to contact me via LinkedIn. I know that in the chat, we've also shared the investor guide that goes into this 8-week Impacting Investing Challenge, who it's for, what you'll be able to gain from it, and that we start in the fall. So thank you so much, Mike, for really putting this together. I think this has been absolutely incredibly invaluable. And and I'm excited to see what happens next within the type of cross-section that this will lend well into the Health Impacting Investing Challenge as well. So thank you. Thanks, everyone.
Thanks for having me. And it's a lot of fun, and we'll look forward to the next IIC.
Sounds good.